Welcome to this explainer. Okay, if you are a non-resident Indian right now, your social media feeds, and honestly, your bank emails too, are probably absolutely flooded with one specific, kind of unbelievable claim, a 20% guaranteed return on fixed deposits. I mean, it sounds like an absolute dream, right? But you know how it goes in the financial world. When something sounds a little too good to be true, well, it usually is. Today, we're going to unpack these flashy claims surrounding recent FCNR deposit schemes for NRIs. We're talking the exact math, the recent policy changes, and most importantly, the hidden risks that they definitely aren't putting on the front page of those glossy brochures.
Okay, let's dive into this. Here is our roadmap for today. We've got 1. The 20% return hype. 2. RBI's policy shift explained. 3. Decoding the 20% math. 4. The hidden leverage trap. 5. Beware of mis-selling. And finally, 6. The final verdict.
Section 1. The 20% return hype.
20% guaranteed return. You're seeing this everywhere, right? It's creating massive buzz and honestly, a ton of serious FOMO, fear of missing out, among the NRI community. When you're visiting Indian banks and seeing global standard deposit rates sitting way, way lower, a 20% guarantee literally makes you want to sign on the dotted line immediately, just so you don't miss out on a once-in-a-lifetime deal. And to make matters crazier, there's a ticking clock. 76. That's the estimated number of days left before this specific regulatory window just snaps shut. Banks are totally using this countdown to rush investors, pitching it as a golden opportunity that is vanishing fast. But hey, to figure out if it's actually a golden opportunity, we first need to understand why this weird little window even exists in the first place.
Section 2. RBI's policy shift explained.
Let's step back a second. Over the last 3 years, the Indian rupee has taken a pretty significant slide. We've watched it fall from around 81 rupees to the dollar all the way to over 95. This kind of freefall puts immense pressure on the RBI, the Reserve Bank of India, to urgently attract foreign reserves. Why? Because they desperately need those dollars to stabilize the economy and manage vital, massive import bills for stuff like crude oil, gold, and electronics. And this brilliantly illustrates how things used to work. Take two brothers. Ramesh lives in India, walks into a local bank, and gets a straightforward 6% fixed deposit. The bank lends his money out at 8%, keeps a 2% profit. Super simple. Now, his brother Suresh is an NRI in the US. When Suresh deposits US dollars, the bank has to convert those dollars to rupees to lend them out in India. But doing that opened the bank up to a huge, ongoing risk, currency depreciation.
Since the rupee typically falls against the dollar every single year, banks had to protect themselves. They did this by paying what's called a currency swap premium. It's basically an insurance cost to hedge against the rupee losing value. But banks, of course, weren't paying this out of their own pockets. No way. They passed this cost straight on to NRIs like Suresh. And that is exactly why resident Indians got 6%, while NRIs historically only earned a measly 2%, 3% on similar deposits.
But here is the real game changer. The RBI desperately needed to boost foreign reserves, and fast. So they stepped in and said, look, we will absorb the currency swap premium cost. Just like that, banks don't have to pay that insurance premium anymore. That massive cost was completely wiped off their books. Because of that, banks can suddenly turn around and offer NRIs fantastic, unpenalized interest rates of 6.5% to 7.5% on their FCNR deposits.
Section 3. Decoding the 20% math.
So the RBI shift totally explains how we get to 7%. But how on earth are banks promising 20%? Well, it is time to pull back the curtain on this financial magic trick. It all comes down to leverage. Let's say you deposit 1 lakh rupees. The bank looks at your strong NRI credit profile and says, hey, let's lend you 9 times your deposit. So they hand you a loan of 9 lakh rupees to add to your investment. Now you've got a total pool of 10 lakhs earning a 7% interest rate. That generates 70,000 rupees in total interest. But hold up. The bank didn't give you that 9 lakh loan out of the goodness of their hearts. They charge you, let's say, 5.5% interest for the privilege of that leverage, meaning you owe 49,500 rupees in loan interest. So the crucial point is this. You take your 70,000 rupees in earned interest, subtract the 49,500 you owe for the loan, and you are left with a neat net profit of 20,500 rupees. And since your initial out-of-pocket deposit was just 1 lakh, making 20,500 is exactly a 20.5% return. That's how the flashy math actually works, on paper at least. It completely solves the mystery of the hype. But, as you probably guessed, there's a pretty massive catch.
Section 4.
the hidden leverage trap. All right, this is where we really need to shift gears to extreme caution. The trap, the dangerous catch hidden deep in the fine print, lies entirely in the type of loan the bank is giving you for that 9x leverage. That 5.5% interest they charge you, it is almost always a floating interest rate, meaning it is not fixed. It's going to change periodically based on broader market conditions. Let's move to and see how this builds into a potential disaster. Initially, you've got a positive net profit. But what if global interest rates rise by just 2%? Suddenly, the cost of your massive 9-lock loan jumps from 5.5% to 7.5%. But remember, the return on your deposit is locked at 7%. Almost overnight, your loan costs more than your investment earns. That tiny little arbitrage window you were chasing is completely eaten alive.
And guys, it gets worse. A rise in interest rates won't just wipe out your profits. It will actively start eating into your initial 1 lakh principal amount. If the math flips against you, you will literally lose your hard-earned money. Chasing a tiny 1 to 2% arbitrage through massive leverage opens you up to terrible risks, especially right now in an economic environment where interest rate hikes are a very real possibility.
Section 5. Beware of mis-selling. Now that we understand the mechanics, we've got to talk about the on-the-ground reality. Bankers know you're busy. They know you might only be in India for a short trip, so they're using predatory tactics. They aggressively push that limited-time FOMO. They rush you into signing thick stacks of documents before you can even spot the fine print about floating loan rates. Even worse, some are using the 20% hype as a total bait and switch. They're disguising expensive ULIPs, unit-linked insurance plans, and traditional insurance policies, pushing them as FCNR deposits to new investors. I'm urging you, meticulously read every single document. And seriously, please share this explainer with your friends and family so they don't blindly sign away their savings.
Section 6. The final verdict.
Now, what's really interesting about this slide is that the boring route is actually incredibly lucrative. Play it safe. Take the standard 7% to 7.5% FCNR return, but explicitly decline the bank's leverage offer. Just deposit your own money. When you combine a guaranteed 7% return with the natural advantage you get as the rupee depreciates against the dollar, your effective yield easily hits the double digits anyway. You get fantastic returns, and you can actually sleep soundly at night, completely avoiding that floating rate trap. So as the bank tells you the window is closing, take a breath, take a step back. Don't let the fear of missing out force your hand. With the clock ticking on these promotional rates, ask yourself, are you making a sound, informed investment, or are you just stepping blindly into a highly leveraged trap? Question those flashy banking pitches, read the fine print, skip the leverage, and protect your capital. Thanks for tuning into this explainer, and keep learning.